Welcome to today's meeting, which is the third oral evidence session as part of the committee's inquiry into the growth of private markets in the UK following reforms introduced after 2008. And thank you to you, Monsieur Véron, for attending. A verbatim transcript will be taken of the evidence and will be put on the parliamentary website. A few days after this session, you'll be sent a copy of the transcript to check it for accuracy, and it would be helpful if you could advise us of any corrections as quickly as possible. If after this evidence session you wish to clarify or amplify any points made during your evidence or have additional points to make, you're very welcome to submit supplementary written evidence to us. I don't know if you want to make a short opening statement or if we should just get straight into questions.
Should I introduce myself or?
Yes, of course. Yeah, go on.
Thanks very much for the invitation to participate. It's an honor and privilege. As you know, I work for two organizations, Bruegel in Brussels and the Peterson Institute for International Economics in Washington, D.C. I should disclose for this session the fact that I've also been for many years a non-executive independent director of the trade repository arm of DTCC, which is a piece of financial infrastructure that collects information about principally derivatives transactions. It has an entity in the UK, which is regulated by the FCA. I'm also an investor in venture capital funds that are managed by a firm led by my brother. I have most of my savings in those funds, so that may be relevant to our discussion, even so I don't think it creates a conflict of interest. As for Bruegel and the Peterson Institute, they have many stakeholders in the UK, including private companies and funds. In addition, Bruegel is specifically supported financially by the UK government and the Bank of England. So that's by way of background. I work mostly on financial services, probably more on the EU than on the US and more on the US than on the UK. I try to get a global comparative perspective on things. I view myself as a generalist. I'm not an equity analyst. I'm not bank capital professional, even so you could call me something like an enthusiastic bank capital amateur. So that's by way of background.
Thank you for that. Perhaps I could begin by asking the first question, which is a general question. How does the approach taken to the implementation of the Basel standards in the EU differ from the approach taken in the UK? And what would you say are the effects of EU bank capital and other regulatory requirements on the growth of non-bank financial intermediaries, in particular private credit? And does the differential treatment between large and regional community or smaller banks in the implementation of the Basel standards in the EU and, for example, in the US influence the access to credit by small and medium-sized enterprises?
So these are vast issues. I will try to be succinct and we can follow up on any point you may wish to drill down on. Obviously, the implementation of Basel III up to and not including the so-called Basel III endgame had been the same in the EU and the UK initially. And that was the successive capital requirement regulations, starting with the one adopted in 2012, 2013, I think, the final adoption. There's a lot of similarity between Basel implementation between the EU and the UK. There has been recent divergence, which is obviously an inevitable consequence of Brexit. The UK, as you know, has delayed its adoption of the Basel III endgame more than the EU. And also the UK is going towards a more differentiated approach depending on size of banks than the long-standing practice of the EU, which is to apply the same capital regulations to all banks irrespective of size. And you mentioned the even bigger difference with the US, where Basel, strictly speaking, is only applied to the GSIBs, the global systemically important banks, while even large regional banks, such as Silicon Valley Bank until its demise, are not really subject to the Basel requirements, even so there is a certain graduation of supervisory requirements for medium-sized banks. So it's difficult to say how that affects behavior. As you know, in that area, tracing the economic impact of regulation can be difficult, even ex post, and even more so ex ante. I would say in general that to the best of my knowledge, there is no evidence of a scarcity of credit in either of the EU, UK, or US. At this point, credit is abundant. There is a feeling in the banking community, I think in all three jurisdictions, even so bankers may say the opposite in public language, that should capital requirements be eased, that would probably have to go into bigger dividends or buybacks for shareholders, given the lack of obvious unmet demand for credit from the real economy. Of course, this assessment is a bit too sweeping, should be nuanced depending on which segments we're talking about and which capital requirements apply to different business segments and lending segments. But I think the general picture, and that's important for our discussion, is one of no scarcity of credit, certainly no credit crunch in the current circumstances.
We've heard that private credit in the United Kingdom is increasingly competing with banking to provide corporate lending, whereas we understand that the private credit market in the EU is smaller, suggesting that banks remain relatively competitive. Did you agree with that? Are banks in the EU better able to compete with private credit in the provision of finance in comparison to the UK? And to what extent is that driven by differences in regulation?
It's a difficult question. I haven't done in-depth work on this area, so I will not pretend to know more than I do. I think the structures for private credit investment may be more mature in the UK than in the EU, so it could be that there is a space for expansion of private credit in the EU that hasn't been filled by market forces, if you will. As a picture in the EU is very differentiated. Private credit developed early, for example, in the Nordics, and I assume, even so I didn't check, that the level of private credit development in the Nordics, which are part of the EU, leaving aside Norway, which is itself part of the single market, I think the level of developments are similar, if not higher, in that part of the EU as they are in the UK. So you also have to take into account the obvious differences of size and structure of the EU compared with the UK, and the fact that the UK, a big part of the UK, is a major financial center, London, which of course cannot be extrapolated to the EU as a whole. So I would be cautious in the comparative assessment. I don't think there are huge regulatory differences. I think where there might be differences is in the broader environment. For example, the court system is very important for private credit, and that the quality of the UK justice system may positively affect the development of private credit compared to vast segments of the European Union, including in Southern and Eastern Europe, without differences in financial regulation affecting those outcomes to a similar degree. So there are also issues of course, corporate governance. Labor legislation plays a big role in this area, as it does in venture capital. The ability to hire and fire is very important for private credit investors. So I would take a holistic assessment of your question and not reduce it to differences in financial regulation in a strict sense.
Well, thank you for that very comprehensive answer for something which you said you hadn't thought very carefully about. That's very helpful. Thank you. Lord Sharkey.
Yes, I'd like to ask about the interconnections between banking and private markets. How prevalent are the interconnections between the banking sectors in the EU and the United States and the global private credit market? And which segments of the banking sector are connected to global private markets?
Answer is I don't know. I would assume that there is more such interconnectedness among larger banks than among smaller banks, but there might be exceptions that I'm not aware of. And there is specialization in those markets. So it might be that in the different jurisdictions that you mentioned, very limited number of banks have exposure to the private credit market, and I cannot tell you which ones. I don't have access to that. I haven't looked at that information. I don't know to which extent there is such information easily accessible in the public domain. What I do know for sure is that supervisors in recent years, and I would say probably in the last 5 years, if not more, have paid a lot of attention to this matter. So private credit is high on the supervisory radar. This is true in the US, the UK, and the EU. So I don't view this as a neglected part of the risk landscape. In recent experience, at least, and I think in long-standing experience, crises tend to appear first in neglected segments of the supervisory radar as a matter of general correlation. Having said that, this is not to say that there's nothing to worry about in terms of banks' exposures to private sector. Here, I would view the US differently from the EU and the UK. I think the quality of banking supervision in the EU and the UK is generally quite high. As a matter of, first order consideration, we may come back to this matter. I think it's about as high in the UK as in the Eurozone. With differentiation maybe for the non-Eurozone EU countries, but that's small anyway. I think the quality of banking supervision in the UK and the Eurozone, and also in non-Eurozone jurisdictions such as Sweden and Denmark, is higher than in the US. And has been higher than in the US for some time. I think it will be useful for that if you want to drill down this issue to look back at the lessons from the Silicon Valley Bank / regional bank crisis of March 2023, which in my view has exposed a significant gap in terms of quality and effectiveness of prudential supervision between the US on the one hand and the UK and the Eurozone on the other hand. And I'm pretty sure that this gap has not been corrected, and if anything is going to increase in the foreseeable future, given the difference in policy directions.
It would be very useful if you could point us in the direction of some literature on the gap you've just been talking about. I mean, not now necessarily, if you can just tell us.
Yeah, I can give a brief answer to that. I'm not aware of good literature on this, so this is based on my personal research and analysis and judgment. Effectiveness, supervisory performance are notoriously difficult to assess. They basically get exposed when there is a crisis. I think we learned a lot about gaps in US supervisory effectiveness during the 2023 crisis. There's a very good testimony which I will submit after this session by a person named Newell, I think, who used to work in the Federal Reserve System but left it before the 2023 crisis, which is mainly dedicated to this issue at the Fed, but doesn't go into comparative analysis with the UK or the EU. Or the Eurozone for that matter. So it is a tragedy that the lessons from the 2023 crisis, which was quite severe, it was a systemic banking crisis, even so it lasted very briefly in the US. The lessons have not translated, to my knowledge, into any policy changes. And to the extent that there were organizational changes, for example, in the Fed system, I assume they have been or will be reversed in short order. So that's not reassuring, and I should add that with the possible exception of the OCC's Office of the Controller of the Currency, banking supervisors had to, pardon my French, egg on their face during the 2023 crisis. That includes the Fed, not only the San Francisco Fed, but also the board of the Federal Reserve. It includes the FDIC, it includes, of course, the state authorities, at least in California, and I think also in New York.
But you describe this as a systemic crisis.
This is not an original way of describing it. The March 2023 crisis has been widely described as systemic by American scholars and also some observers from the supervisory community, at least in private. The crisis was very intense. The systemic risk exemption was triggered, as you know, which is the hallmark of a systemic crisis. And it doused the fire very quickly. You remember it took a few weeks to address the situation at First Republic, but there was no turmoil after the weekend of crisis management. That said, it was systemic in nature and, as you know, also affecting very large banks that failed in the circumstance or were dechartered, which in U.S. historical perspective, even adjusting for inflation, were among the largest in U.S. banking history.
Could I ask you a little more about the banks in the EU and the US? We've heard evidence that these banks are establishing joint ventures with private credit funds. Are these trends present in the EU and the US? And if they are, how prevalent are they? What's driving that?
I haven't looked at this in detail. I would not be surprised to see the same kind of joint venture or partnering from Eurozone or US banks, probably more the G-SIBs than any other segment of the banking industry, but maybe also some medium-sized banks in both the US and the Eurozone. But I haven't looked at that in any detail, so I cannot describe the kind of transactions that have been considered or implemented.
I mean, is it the case, for example, that the banking sector is increasingly interconnected to private credit markets in the US and the EU?
The private credit business model has been changing, and it increasingly includes elements of leverage, to my knowledge, and also connection with the insurance sector, which maybe should be more of a direct concern than connection with the banking sector, at least in a first order of magnitude. There was...
Sorry, could you elaborate slightly on that, your comments about the insurance?
Basically, private credit groups in the US have established insurance affiliates, life insurance affiliates, mostly Apollo, of course, comes to mind in that practice, and they have started to export this model, which could be viewed as regulatory optimization, if not arbitrage, and those insurance affiliates, life insurance affiliates, are big investors into the private credit activity. There is I don't know if you watched the speech and Q&A by Michael Barr, governor of the Federal Reserve System, last week at Brookings in Washington, D.C. The speech was all backward-looking about lessons from 3 episodes of deregulation and crisis in the U.S., but it was obvious that it was intended to apply to the current situation in the U.S. and risk going forward. And if you listen to the Q&A, which was brilliantly managed by David Wessel at the Brookings Institution, there is a lot of information there on the Fed's current assessment of financial risk built up in the US, including in private credit. So I think there was 1 or 2 questions and answers from Michael Barr on this issue. That's my most current knowledge about the US situation, and he emphasized this linkage to insurance in a way that I found very clear.
Do you have any general comments about the implications of interconnections between banks and private credit and financial stability and growth?
Supervisors have their eye on this issue and have had it for several years. Given that I assess the quality of prudential supervision in both the UK and the EU, if not in the US, as quite high, I'm not overly concerned by the buildup of exposures, which is probably going upwards, not downwards, in the Eurozone and in the UK. I say Eurozone rather than EU because I have not worked in detail to the non-Eurozone countries. But again, to give an order of magnitude, Eurozone banking assets are about a bit more than 90% of EU banking assets. So the bulk of the EU banking sector is indeed in the Eurozone under the supervision of practically the ECB within the framework of European banking supervision, the single supervisor mechanism. In that context, I wouldn't think of it as a major concern that might have escaped the attention of supervisors in the Eurozone and UK. I wouldn't say the same about the US because of the systemic flaws in the performance of prudential supervisions that we observed in 2023. And as I said, I don't think these gaps have been corrected.
Thank you, Chair.
Staying with the question of interconnectedness, are you satisfied that there's sufficient data and information about the the secondary market? And I think in your rather interesting titled book that you co-authored, Smoke and Mirrors, Inc., Accounting for Capitalism, you draw attention to the rather creative nature of information that's available on the secondary finance market and the dangers that can be taken, that there are on the information that's provided. So how do we tackle getting sufficient information on the secondary finance markets, given their accounting practices, which you explained very carefully and rather colourfully in your book? to make sure that it is adequately regulated?
Thanks for mentioning this book co-authored with Mathieu Autré and Alfred Galichon, but the book was published 20 years ago and was written more than 20 years ago. So I wouldn't take it as current analysis, even so the intention of the book was to describe timeless practices of accounting shenanigans. So there are several levels of information here. There's accounting information, so in the financial statements of the banks and of other financial and non-financial firms. There's supervisory information, which is accessible to supervisors, particularly on banks' exposures, which is not accessible to the public. There is so-called Basel Pillar 3 information, which is information that banks have to disclose beyond the applicable accounting and financial reporting requirements under the so-called transparency pillar or market discipline pillar of the Basel framework. This Pillar 3 information has traditionally been of very variable quality, but there has been an enhancement of the Pillar 3 disclosures standards or guidelines, both from the Basel Committee in general and in the European context more generally. So there have been some improvements. Having said that, I think the short answer to your question is that this remains an area that is not very well covered by public disclosure requirements. I'm not sure I can say the same about supervisory disclosure requirements, which, as I said, are non-public. The information is available to supervisors on a jurisdiction-by-jurisdiction basis, but not available in the public space. It's very difficult for me to assess the quality of those supervisory information flows because I'm not a supervisor, and therefore I don't have access. Michael Barr, in his speech, suggested that even supervisors in the US don't have the information they would need. Whether that's also the case in the UK or in the Eurozone, I frankly don't know. I wouldn't take it as a default assumption that the practices are identical in the Eurozone and in the UK to what they are in the US. I would add, because I have special knowledge about this through the point I mentioned of being an independent non-executive director of the trade repository arm of DTCC. Even so, I'm not speaking here in that capacity. That has given me exposure to the issue of derivatives trade reporting, which is a very important and interesting part of the broader disclosure and information theme. So happy to discuss about that. If you think of an incident like, for example, Archegos a couple of years ago, this buildup of exposure should have been visible through the information infrastructure that has been put in place with derivatives trade reporting since the early 2010s. Unfortunately, it wasn't for reasons I can explain, but I think the working on this kind of information systems of the kind that is provided by trade repositories and with due awareness of what may be perceived as my conflict of interest here, which I don't view as a conflict, but as a point of just better information for me about that segment. I think that's a very important issue for financial stability authorities. It includes different difficult matters of cross-border cooperation among authorities, which is sometimes impeded by national legislation, but also sometimes impeded just by the intrinsic reluctance of authorities to share sensitive information.
Would you like to see regulators push for greater transparency of the interconnectedness between the primary market and the private market, and also, as you've just touched upon, the relationship internationally, because a lot of these transactions with the private finance sector from the primary banks are in fact done internationally. So is there a case for a much greater transparency in those relationships?
I understand your question as meaning public transparency. Is that correct, or do you mean transparency to authorities?
I mean public transparency, particularly in the context of the fact that a lot of risk in the private sector is distributed to small and pension funds, small investors, and in other words, it's a distributed risk, which in some ways the regulator can say, well, that's fine, the risk is distributed, it's not concentrated. but the relationship between the primary market and the private finance market in very great size is a systemic a systemic risk.
Pension funds are regulated and supervised. They have a prudential framework, so that's supposed to address some of those issues. Whether it works or not, of course, depends on jurisdictions and observed experience. And I'm very much of the view that, caveat emptor, as Commissioner Maria-Luisa Albuquerque, who is in charge of that in the current European Commission, put it recently, and I thought it was a good way to put it, the private savers and investors should be protected from fraud and malpractice. They shouldn't be protected from themselves. So that means that at the end of the day, the investment of investors, including retail investors, has to rely on judgment, and there's only a certain extent to which regulation can prevent bad investment. Having said that, pension funds are of a public interest nature. They are regulated and supervised as such, and of course, so are banks. So it's a matter of fine judgment what has to go into information provided on a confidential basis to supervisory authorities and what has to go to the public domain. I think there is a good case to be made that the system can not only rely on disclosures to supervisory authorities. There has to be an element of public disclosure that creates or fosters market discipline. As I mentioned, that's the reason why the Basel framework has a third pillar, which is specifically about that public information intended to foster market discipline. And I think that's true of the financial system in general. We want enough information to be around so that the public and public investors have an understanding, a broad understanding of the system. Having said that, I think there is a reason why there's a private and a public segment of the financial system understood as publicly listed or issued securities and private investment by private credit or private equity investors. And the very nature of that divide is that there is more information in the public space than in the private space, understanding the semantics as such. So then the question becomes, how private is private? Should we think in terms of thresholds? Should we think in terms of general information requirements? For example, in my country of France, every corporate entity, irrespective of size, has to publish financial statements and make them available at the local business court. Whether that's overkill or not is a matter of debate. There is no similar requirement, for example, in Germany, and that creates a big difference in the structures of the SME systems, even so the French requirement is not universally complied with because enforcement is somewhat lax. Difficult question. My general view is that this issue should be viewed dynamically. The authorities in charge of financial stability, which practically means central banks, should have an understanding of the size and systemic relevance of private markets. And the applicable regulation should give those authorities the information they need to assess this systemic relevance. I mean information to central banks, available to central banks, not to the public. On that basis, those authorities in charge of financial stability, practically central banks, should inform and advise legislators in terms of public disclosure requirements. If there is no systemic relevance of private markets, then you could say, this is a bit of a Germanic way of looking at it, let private be private. Why apply public transparency requirements if they're not needed for the public interest? So privacy applies in that case. If there is a matter of systemic relevance, then it becomes a matter of public interest. I'm inclined with some trepidation or some reluctance to leave that assessment to the judgment of central banks in their role as advising legislators. I'm aware of the shortcomings of central banks in making that assessment, but I think at the same time, the view that the divide between private and public markets should be maintained as a matter of general policy is not absurd. So I would view that very dynamically. I'm not myself in a position to make a recommendation on exactly where the boundary should be and what the granular requirements should be for different categories of participants in that market. I haven't done the homework, but it's a very timely question.
Thank you.
Lord Lilly.
We're told that since the financial crisis of 2008, growth of lending by banks to business in the States has returned to the rate of growth prior to 2008. But this side of the Atlantic, both in the UK and in the EU, that hasn't been the case, and credit growth has been slower than it was before 2008. Three explanations put forward for this. One is that the growth of credit has been more restricted this side of the Atlantic because of more restrictive imposition of Basel. The other is that there's been a growth of non-bank lending, or more presumably this side than the other side of the Atlantic. And the third is that demand for credit has been slower this side of the Atlantic. It hasn't returned to the rate of growth it had before 2008. A, which of those answers do you think are true? B, you referred to a slower growth of credit in your answer. So if that is your answer, why has slow growth of demand for credit, why has demand for credit this side of the Atlantic not returned to its previous growth rate?
So a lot to unpack here. As you understood already, my inclination is to emphasize number three. As to number two, I guess the significance of private sector in relation of private credit in relation to bank credit is probably higher in the UK than in the rest of Europe, to use a correct geographical vocabulary. So the UK and EU situations cannot be equated, including in respective comparative perspectives vis-à-vis the US.
But why has demand grown more slowly this side? Why hasn't it returned to the rate of growth?
Economic growth has been generally weaker on this side of the Atlantic than in the US, as is well known. That's the Mario Draghi report.
Why since 2008? You can't explain a change by a constant. If we have been constantly growing slower, that doesn't explain why we're growing relatively more slowly since 2008.
I think before 2008, there was excessive credit growth in the EU, and our banking sector in the EU, including for that matter the UK, was subject to very ineffective prudential regulation and supervision. So in general terms, if you look at the run-up to the great financial crisis, the quality and effectiveness of banking prudential regulation and supervision in the US was higher than in the EU, including the UK. And I think there has been excessive credit growth in EU banking, including UK banking, the run-up to 2007-2008 in a way that hasn't been observed in the banking sector, again, leaving aside non-banks, in the US. So that matters for your comparison. And now it's you would need to say, okay, what was the starting point of this gap in prudential in prudence in the respective banking sectors? It's becoming, your base effects start to have a major impact on your comparison, and I don't have the numbers precisely in mind to expand on that apples to apples determination. But I think the credit growth of the years before 2007 shouldn't be viewed in the EU, including UK, as setting a standard of best practice. So that's probably a big part of the answer. I mentioned the absence of credit scarcity in my observation in the EU or UK at this point. There's also no credit scarcity in the US. The way this is addressed by banking and non-bank entities, respectively, I don't have all the numbers precisely in mind.
Thank you. So if there was too rapid a growth of credit this side of the Atlantic before 2008, that implies there was also too rapid a demand for it. Because if you're saying it only grows if there's a demand for it,
I think we saw that indeed. We saw excessive borrowing in the run-up to the great financial crisis, and this was more generally channeled through the banking sector in Europe than in the US. Yes.
Thank you very much. Thank you, Chair.
Anna Snokes.
I just want to explore the extent to which stress testing has been deployed by central banks and the regulators to assess the impact of the interconnectedness of private capital and the banks, and whether the stress tests that have been carried out in relation to the systemically important banks have, to your knowledge, explored the impact of that interconnectedness on individual institutions, and whether or not those charged with financial stability have tried to stress test the financial systems on a broader basis of the impact of stress on say, the private capital markets and the impact that would have through the financial system.
This issue of stress testing has to be viewed very dynamically because 10 years ago, stress tests were established practice in the US and the US was viewed as best practice for stress testing. You can see, for example, the book on stress testing by my former colleague at the Peterson Institute, Maurice Goldstein, Banker's Final Exam, which very much crystallizes that stylized picture, which I think was accurate at the time, 10, 12 years ago. In the meantime, there has been a lot of buildup of stress testing practice in the Eurozone and the UK in particular. And at the same time, I think the practice in the US has deteriorated quite significantly in quality. And this deterioration will probably accelerate under the current leadership in charge of that kind of activities. So essentially what I'm saying is that the US was better than Europe, EU and UK 10 years ago. Now EU and UK are probably better than the US in terms of the qualities. That doesn't mean EU and the UK, by the way, are where they should be. And then the extent to which that includes private credit, again, I haven't done the homework. I don't even know to which extent that information is available in the public domain, and that could be different between the UK and the Eurozone or the rest of the EU. Maybe it is. I haven't checked. My previously made point applies here. I think authorities in charge of financial stability have private credit on their radar. So I'm very confident they have considered it for stress testing to the extent to which they have implemented that consideration so far or plan to implement it in the future. I don't know.
Is there any way of finding out?
Well, I should have worked on this. I wasn't able to do so for the preparation of this hearing. So looking at all the...
It was not a criticism of you. I'm sorry. It was a general question of whether I could go and look for something somewhere.
The central banks disclose some of their stress testing assumptions. They, of course, disclose the macroeconomic scenario under which they stress test the banks. They don't necessarily disclose every single element that goes into their stress test practice, including modeling, if they do any modeling. The way the modeling practice is shared between the central banks, prudential authorities, and the banks themselves differs a lot between the US, the UK, and the Eurozone. So you have different ways of sharing the burden of stress test modeling. And that has also evolved over time. So it's quite a complex issue, and I don't have a recent update for you. But there is some of it that is disclosed by the central banks and prudential authorities. Possibly there is more that they would be willing to share in a public hearing. So I think the usual instruments apply.
Thank you.
Lord Hill.
Thanks, Lord Chairman. Good to see you. Can I just test a couple of things with you? So you argued, I think, as have other witnesses we've had, that you don't immediately see financial stability risk from the spread of private credit. If that's the case, is it your basic view
therefore, that this is a benign development, and if there is less financial stability risk, is this something that should be encouraged?
Nothing is benign in the financial system ever. Financial stability authorities should be paranoid. They are, or if they aren't, they're not doing their job. And assessments such as the one you suggested, which is, is the development of private credit a good or bad thing, are dynamic in nature. They're not made forever. So authorities have to update them constantly. I think there has been a pretty long period of time where there was a convincing case to be made that private credit was benign. That investors had enough skin in the game, the incentives were the right ones. Essentially, investors had loss absorbing capacity, and that was the right framework for risk taking. As I mentioned, listening among other sources to Michael Barr last week, my impression is that in the US there has been a shift away from that picture of benign private credit because of the buildup of leverage and of the involvement of life insurers, some of which are controlled by private credit groups, into the business model. Whether that also applies in Europe at this very moment, and maybe in a differentiated way between the UK and the Eurozone, is a question I don't have an answer to. I think, again, this is dynamic. You need to rely on recent information. I haven't done that work. But I think the answer to your question is certainly that until recently, the benign epithet probably applied. Whether it applies now, I'm not sure. Whether it will always apply in the future, certainly not. It cannot be taken as a default assumption. And therefore, if you think of, which I think was implicit in your question, if you think of legislation and rulemakings that would set incentives to invest in private credit, including, for example, in terms of tax treatment, I think here, I will be a classic economic type here. Distortion should be minimized. It should be left to the judgment of investors which segments of the financial systems they want to invest in. So I'm very cautious about creating incentives for investment in private credit. The segment, as you know, has developed as a purely market-driven trend so far. That has not prevented its development. So I don't see a case for the authorities, particularly fiscal, but also super regulatory, to go out of their way to give them a comparative advantage.
Yeah, no, so that was not meant to be implicit in my question at all. I mean, I was approaching it from the other end, really, which is that you can see people starting to raise the question of whether you need to regulate and restrict the growth of private credit. As you might expect, I do not think that one needs incentives, as you rightly point out, to stimulate further the development that's happening of its own accord. The other thing I wanted to ask you really was your view on whether the regulation of the banking sector that we have seen has had any effect at all in terms of stimulating the growth of private credit markets.
Yeah, I mean, private credit is intrinsically a consequence of the fact that banks are regulated, right? So banks are regulated for good reason, because banks create money. Money is important to the public interest. So far, private credit groups have not created money in general. As you know, the definition of money is tricky. So I think the concerns at this point is that we may be approaching a point where private credit investors create money in some ways. We're probably not yet there. If that's the case, then there is a case for regulation. So it really depends on the nature of the business models, the practices, the public perception. The same is true in crypto, by the way. And I'm certainly of the view that anything that has to do with money has to be regulated. Defining what has to do with money is, again, very dynamic, because financiers are constantly, and since the beginning of financial times, if I can put it that way, have constantly tried to create money outside of whatever segment of the system was under public oversight. So in a way, nothing new under the sun. But again, I insist on the dynamic nature of that question.
Yeah, and I've just finally, briefly, the something we've discussed many times over the years, the relative overdependence of Europe on the banking sector as a means of providing money for growth, and that and the point you've just made that there must be some effect through the regulation of the banking sector on the availability of capital. Given that we're still waiting for the Savings and Investment Union to fill the gap, shouldn't Europe want to see more rapidly the development of private credit to fill the gap that has perhaps been left by the over-regulation of the banking sector, or do you not see it like that?
Like that, but I would say that's part of the Savings and Investment Union, 100%. So if the Savings and Investment Union means something, open question, it has to include your question. Now, what is the issue here? And indeed, we've debated this for a long time. The starting point, arguably, is not when Jean-Claude Juncker coined Capital Markets Union in July 2014. It's rather the Segre report to the Commission of the European Communities in 1966, so more than half a century ago. What is the Savings and Investment Union, or to use the old-fashioned language, the Capital Markets Union? It's a vision that there should be proper conditions for non-bank capital markets activity to provide the funding that the economy needs in complement to bank finance. Capital markets also have to be regulated in a different way from banks. It's not about prudential regulation. It's mostly about conduct. The UK architecture has a neat differentiation between the PRA and the FCA. I think that's a wise choice, by the way, but of course has to be managed effectively, which I believe has been the case so far in the UK. The issue in the EU is really about this conduct supervision, and that's what's been lacking historically. One word to summarize the situation: Wirecard. In the biggest country of the European Union, Wirecard has demonstrated that conduct of business, supervision or oversight of capital markets activity was failing on almost any segment that you can think of: accounting, auditing, listing, public disclosure requirements of listed firms, you name it. And of course, public transparency, because famously BaFin sued the FT when the FT revealed what was going on instead of caring about what was wrong at Wirecard. So when you have that extent of systemic failure of basic oversight and supervision requirement in the biggest economy, it's not surprising that capital markets development in the EU is lacking. We've had that discussion before. I think the reform of supervisory architecture here is front and center. It may not be a low-hanging fruit, but it's the center of the discussion. And I think now that the UK is outside of the EU, it should be actively understood in the UK, as it is, I think, in many parts of the UK policymaking environment, that capital markets development in the EU requires supervisory reform and, yes, supervisory integration. So I think the central issue of the Savings and Investment Union agenda, including indirectly the development of private credit to the extent that development is benign and useful, has to be the complete reform, ambitious reform of what currently is a dysfunctional supervisory framework for conduct of business, supervision of EU capital markets.
Thank you. Lord Poe. Thank you. I wanted to ask you if you could provide your reflections on the conclusions and the recommendations that the Draghi report into EU competition have made on the EU's banking sector and the over-reliance of business, as he puts it, on the banking sector. And then what impact you expect that to have on the future of regulation of the banking and private credit markets over the next few years?
So the Draghi report, as my colleague and boss at Bruegel, Jérôme Zettelmeier, has eloquently developed, is a mixed bag. There are some very good things in the Draghi report. I think the general emphasis on, the sense of urgency to work on European productivity and competitiveness is absolutely sound and timely. When you look in the details of the recommendations, again, pardon my French, but that's a bit of a dog's breakfast. And particularly in terms of financial sector recommendations, it's not even clear what process led to the drafting of the Draghi report, relevant Draghi report sections, the way they were drafted. Some of those recommendations are sound, some of them are half-baked, some of them are questionable. I don't think they are the Bible for subsequent EU policy action. I don't think they're viewed as such by the European Commission. Even so, at a high level, political level, the Draghi emphasis on competitiveness and productivity, again, is, I think, correctly taken as a mantra by the European Union. So, essentially, I would use the Draghi recommendation on financial services reform as inputs to the EU reflections, but not as an intangible roadmap by any means.
You agree with his point that the one sort of regulatory point he raises is around the difficulties around securitization of debt. Do you agree with that issue?
I don't think it's the biggest issue in the landscape, frankly. The European Commission has made proposals, I think last month or earlier this month, I don't remember, on securitization. There is a process now that will start on, bringing them to fruition. I don't think that changes the game in a major way. I mean, compared with other things we've talked about today, this is a relatively niche concern, but legitimate one for discussion. I think the broader question that is very much in the landscape, and I've paid attention, of course, to the Chancellor's mentioned House speech a few days ago, is simplification and the subtle dialectics between simplification and deregulation. Simplification is not necessarily to be equated with deregulation. There can be a scope for simplification that makes the life of business and banks also easier without amounting to a relaxation of the legitimate requirements in terms of prudential and conduct of business policies. I think we have ample scope for that in the EU, perhaps more than in the UK, because in the EU we have a major driver of complexity, which is the uneasy compromises that have been made over time between the national and the European level, which don't have an equivalent in the UK, the UK being for the purposes of that discussion, a unitary state, and therefore with a very simple jurisdiction, single jurisdiction, which encompasses all the lands and countries of the realm. Not of the crown, I guess. So probably my vocabulary is not exactly right, but you will correct me appropriately. I think in the EU there is a lot of scope for that kind of simplification. With my Bruegel colleague Juan Merino Lopez, we produced a study a couple of weeks ago for the European Parliament, which I think has been circulated to this committee, which goes into how to simplify the macroprudential framework and more broadly the banking framework through the completion of banking union. We know that this is politically difficult, and therefore I don't expect it to happen tomorrow morning. But I think completing the banking union is actually the biggest thing the EU could do to simplify its banking policy framework in a big way. Similarly, by the way, the recommendation of supervisory integrations that I just outlined in response to Lord Hill in the area of capital market supervision, which is mostly about conduct of business and therefore doesn't have the quasi-fiscal undertones of the banking union and prudential discussion, I think that supervisory integration, if done well, and I've just contributed to that debate with a publication at Bruegel, would be a massive simplification of the environment for capital markets in the EU. Again, these issues of national versus European don't translate to the UK, so they're interesting for the UK to observe because the EU is next door, but they're not relevant to the domestic UK discussion. Is there scope in the UK for massive simplification? I'm not sure. I think in international perspective, as you probably know, so both the UK regulatory frameworks and its supervisory implementation, primarily by the PRA, the FCA, also the FRC, are viewed as global good practice, in some segments even best practice. So I don't view the UK as having a particularly acute problem of supervisory effectiveness, including in this concern of complexity or simplicity. But of course, no system is perfect.
Thank you.
You might send you a copy of our latest report on that matter. Baroness Bowles.
Right. Good to see you again, Nicholas. I'd like to go back to what you said about caveat emptor and also sort of Lord Hollick's questions about transparency, because they kind of go together. And at the moment in the UK, there is sort of a head of steam building up to encourage more retail investment, not just in equities on the stock market, but also in private capital instruments. I'm asking whether that balance is right. You can stress test what the banks hold, you can stress test what an insurance company holds, and those things can go on, but how do you stress test what's in the individual pensioner's portfolio, especially if they're being directed in the direction that private capital is a very good thing, and at this particular point in time when a lot of it has become extremely illiquid. I realise that's a sort of very all-encompassing question, which I'm sure you're used to, so do your best.
This is also an age-old trade-off, right? So if you want to protect retail investors, you have to bar them from investing in things that, even with good financial education, they will not fully understand. And you will reserve those investment opportunities to professionals, but then that means that those professionals have access to better investment opportunities than retail. And that's kind of shocking from a public perspective, even so, there's a certain logic to it. So that trade-off is politically difficult to manage. It always has been, always will be. That's why pension funds are regulated and supervised. And again, I think if you look only at the UK, the relatively recent episode of liability-driven investment funds making some engaging in practices that weren't perhaps optimal. I think that was a failure of supervision, frankly, and probably hasn't been viewed as such to the extent it should have been, at least in the public debate. I mean, I'm not, the British media are very vibrant. I haven't read everything that was written about the LDI episode, but to me, the supervisory failure element of it was a major component. I haven't followed the UK debate enough to know to which extent it has led to reform of pension fund supervision. But again, pension funds are supervised. Conversely, if I engage in day trading from my computer and buy and sell securities or crypto, that's my risk. And I think that's fit and proper. So yes, financial education can bridge that gap to a certain extent. I think only to a very limited extent. At least historical practice has been sobering in terms of financial education as a policy instrument to help managing this kind of risk. So it probably has to remain the case that some pretty juicy investment opportunities are not open to retail investors just because there's too much complexity and the relevant information cannot be entirely provided in the public domain. As a matter of general principle. Now, policymakers have good reasons, and political leaders and elected politicians have good reasons to minimize that gap between the investment opportunities available to the general public versus professional investors. I think the gap should be reduced to the extent reasonable. It cannot be entirely eliminated.
So you don't use this retail involvement as a reason for there to be additional transparencies. It's still going to be a supervisory decision as to whether the investment is accessible or not. I mean, this is going to be a very grey area.
And it does call crypto into mind, even so we've not talked primarily about crypto today, which is a relief for me. But we have contract freedom in our systems. We have freedom for private parties to engage in financial transactions that are not regulated as a matter of default, and that includes provision of public transparency, right? So if we want to keep that feature, which I think is a fundamental feature of our system and is generally good if properly managed, you will always have situations where retail investors engage in transaction for which there is no publicly enforced transparency. And crypto is a massive illustration of this feature. We can discuss whether it has gone too far, but I think it was not unreasonable at the beginning of that sequence for authorities to say, this is caveat emptor territory. We're not regulating it, including for transparency purposes. Now, of course, the crypto service providers say there's total transparency because it's crypto. As we know, this proposition has to be somewhat nuanced. And that's even more the case when we talk about stable coins, of course. So lots of issues in your question, but I maintain my general view that there will always be a space for private contractual freedoms that is not covered by public transparency requirements. And I think that's an inescapable feature of our market-driven system.
Okay.
Thank you. You did refer earlier to the dysfunctional supervisory system. And what concerns me is, if you like, an ordinary member of the public is, how can we trust that system if your implication is that they're not sufficiently joined up to see things coming down the line? One of the aspects, it seems to me, of some of the biggest financial scandals is that outsiders didn't see anything coming, and there is lack of visibility about the extent to which insiders knew what was coming down the line. So what kind of reassurance could you give to me that, firstly, this dysfunctional supervisory system has a handle on, say, valuation of the private system, the visibility of bad actors, and the responsibility of supervisory's failures?
I'm not sure I was clear enough. When I referred to dysfunctional system, I was referring to the European EU supervision of capital markets, so not the UK. And the reason the EU system is dysfunctional, as I elaborate in my recently published essay published by Bruegel, is essentially that it doesn't have the right incentives. So national capital market supervisors in the EU countries, because of the existence of the single market, have incentives to promote and protect national financial champions, which is exactly what happened with Wirecard, to the detriment of their public interest role of enforcing conduct of business requirements and also some prudential considerations. This assessment doesn't apply to the UK authorities, whether the FCA, the PRA, or for that matter, the FRC, which don't face the same perverse incentives, which frankly is a consequence of the single market. So one reason why they don't face those perverse incentives is that the UK has left the single market, which is not necessarily a good thing for the UK, but closes that gap in supervisory governance. I'm not sure if that's clear enough, but that's by way of clarification.
It is clear, but it still implies that there is a difference of emphasis on the international supervisory world, that there are different systems and that there isn't sufficient joined up supervision.
As I mentioned, the UK supervision in that domain is generally viewed as good practice. I think that's good news for the UK. International coordination is difficult. I said very critical things about how it works in the EU because of this incompleteness of the single market in terms of supervisory architecture. But even the EU is better than some other jurisdictions around the world. Actually, it is probably in the best quartile if you think in terms of number of countries or population. So it's all relative. And obviously, we don't have a world government. We can only strive for global cross-border convergence, global standards. We should build them up. I think that applies particularly for transparency requirements, and I would be delighted to expand in terms of the important, if limited, segment I mentioned of derivatives reporting and transparency. I think we're missing an instrument for global coordination and better practice and more joined-up framework in that particular area. But we must also be realistic about the scope for full convergence of outcomes when considered at an international level. So in terms of looking at it jurisdiction by jurisdiction, how can we trust supervisors? I think it's a constant work in progress, and supervisors can fail at any moment. So they have a very difficult job of ensuring constantly high levels of supervisory performance. That's why I mentioned that they must be paranoid, and that, by the way, applies to, of course, prudential regulators, but also to conduct of business supervisors, such as the FCA and also the FRC. So that leads some to deem them as risk averse. That's probably a feature, not a bug. To the extent they have a public interest mandate, they have to care about risks and avert risks. That can run them into overdrive. And it is the job of legislators to check that. But the risk aversion of supervisors, of financial supervisors, I think is something to be generally welcomed. And so that's why legislators shouldn't regulate everything. That's why there should be a scope left for contractual freedom without public supervision when it doesn't extend to systemic relevance, certainly, as I mentioned in my previous question to and I think to the previous question, and I think this is very important. There are multiple trade-offs here. Generalized, heavy-handed regulation is not the answer, nor is complete laissez-faire. We've learned that at great cost, and finding the right balance is incredibly difficult, has to be revisited every day.
Thank you. It would be very useful if you could provide us with more information about the visibility issues and the data issues. Thank you.
On that note, Monsieur Véron, I think we've run out of time, and on behalf of the committee, I'd like to thank you for what's been a fascinating session, where you've drawn out some of the balances that need to be set and explained the background to these quite complex issues. So thank you very much indeed, and we will send you a copy of the report, and we'd be very interested in your comments on our comments on the degree to which the regulators are too risk averse. So thank you very much. We're going to take a short break in the public broadcast before we hear from Professor Wilmarth. So on that note, that concludes this part of the session today. Welcome to the second part of today's meeting, which is the third oral evidence session as part of the committee's inquiry into the growth of private markets in the UK following reforms introduced after 2008. And thank you particularly to you, Professor Wilmarth, for attending. I know it's very early in the United States, and we're very, very appreciative of you, not just helping us with by doing this session, but also with the paper which you produced, which will be available on our website once the session is over and you've had an opportunity to take into account any of the questions that may be asked. Do you want to make any kind of opening statement by way of introduction or otherwise? If so, please do so now.
Thank you very much, and it's a pleasure to be with you this morning. Just two things. I've been studying the banking and financial system mainly in the United States, but also on your side of the Atlantic for the past 50 years. And I would say the two largest changes that have been made during that period, which I think are very much implicated by your hearing this morning, are these. First, we've allowed banks to get far away from their traditional business model, in a sense, and to embrace all aspects of the financial markets, which is a very dramatic change from where things were in 1975. And Secondly, we've allowed many other types of institutions effectively to get into the banking business by engaging in what has become known as shadow banking, essentially engaging in banking activities, particularly taking deposit substitutes and providing credit, but without the kind of regulatory safeguards and regulatory requirements that we apply to banks. And I think both of those developments have caused many of the problems that we've experienced, particularly over the last 25 years, 30 years, and that have raised many of the problems that you're looking at today. Thank you.
Okay, perhaps I could ask the first question, which is whether the differential treatment between large and regional community or smaller banks in the implementation of the Basel standards in the US has influenced the access to credit by SMEs, and who is actually lending to SMEs in the US, and what factors are driving this lending?
Yes, I think what you've seen in the United States, and is certainly partly a result of the crisis and its fallout, is that we've seen a very dramatic reduction in smaller community-oriented banks, so that what we would consider community banks are about half of what they were 25 years ago, down from about 8,000 to 4,000. Share of banking assets is down from about 28% to 12%. That has certainly, in my opinion, impaired and reduced the availability of credit to SMEs. Community banks, I think, still do an excellent job, but there just aren't as many of them, and they don't have as many assets. If you look at the capital ratios that they maintain compared to the large banks, I mean, they're dramatically larger. Community banks generally have tier one equity capital ratios on average well above 10%. And for the largest banks, it's around 7 now. It's down from about 9% in 2017. I think those capital ratios, the differentials, can't be explained any other way but that the too big to fail policies, which we have followed in this country and in many others, have certainly given the large banks a tremendous advantage over smaller banks. And large banks, unfortunately, just haven't shown much interest in providing loans to SMEs. They cut their small business lending very drastically after the crisis. In my opinion, it really has never come back. They make their small business loans primarily through credit cards in a very standardized manner. You don't see the large banks making what we would consider classic relationship loans to what I would consider classic SMEs. I mean, there may be, you may have support for some venture capital startups that are considered to be very hot. For example, I'm sure if you present yourself with an AI business model, you might get some very interesting attention from the bigger banks. But if you're a classic small business operating on what we would call Main Street, you would call High Street, there isn't a great deal of interest among the big banks.
Could you explain why that is?
I think from the big banks' perspective, what you hear is that it's just too costly. That the amount of small businesses, of course, generally don't have credit ratings. They operate in niche markets, both geographically and product markets. And so it takes a great deal of inquiry and familiarity with the geographic market, with the product market they're serving, with the entrepreneurs to determine whether they are creditworthy or not. Certainly, small businesses have a much higher rate of failure compared to large, well-established companies with good credit ratings. So for the big banks, I believe they feel there isn't enough of a margin. Now, I've made the suggestion that if we actually required large banks to get back to the traditional business of lending and to get out of the capital markets business, perhaps they would have an incentive then to examine more creditworthy borrowers. I would point out that the first 6 months of this year, the 5 biggest Wall Street banks have reported trading revenues that are truly extraordinary and amounted to about 20% of their total revenues. I think Wall Street is celebrating. I don't see that as a healthy indicator of what banks should be doing. That's certainly where we've been moving in the past 30 years, but I think it's had an inevitable impact on the traditional business of lending. I was looking at the FDIC statistics. The loan and lease ratio to total assets is around 40% for the big banks over 250 billion. That would indicate that they're not devoting most of their attention to lending. They're doing other things.
I was quite fascinated in your paper. You suggest that for the smaller community banks, that they are over-regulated, and that simply by focusing on capital and liquidity requirements, a whole load of regulation and therefore cost dispense with. Do you think there are lessons there for the UK?
Yes, I think there are two problems, I believe, with our community banking regulation. One is that I don't think the full suite of Basel III is necessary, and I'm pleased that the regulators have adopted this community bank leverage ratio approach, which, if you look at it, is fairly demanding. I mean, they require pretty strong evidence that the bank is well managed and well run. If they maintain Tier 1 leverage ratio above 9%, they are excused from the other Basel III risk-based requirements under the so-called standardized approach. I think that's a very favorable approach. I noted that about 40% of community banks have opted for that approach, so they obviously find it valuable. The other thing I would say is that we just haven't approved enough new community banks. The de novo bank formation in this country has fallen very far compared to what it was before the financial crisis of 2008. I believe less than 100 new banks have been formed since 2008, maybe less than 80. That's a very low rate for us historically. I think it's ironic that we focus that the regulators seem to be so focused on not approving a new community bank that will fail. And I understand failures are very disruptive and costly, but we haven't seemed to apply the same degree of stringency to much larger banks that take much larger risks. And they seem to assume that when they run into trouble, they'll get a lot of support, which they do.
It's just finally, it's been suggested that the current US administration will likely relax banking standards or possibly withdraw from Basel altogether. Do you agree this is likely? And if so, what aspects of the US bank capital and liquidity requirements do you expect to be scaled back?
I think that you've seen the first one, which is that they're proposing to reduce the enhanced supplementary leverage ratio for the largest GSIBs to a range of 3.5 to 4.25%, which would be a good deal below the current minimum, which is 6%. That would be quite a drastic change in my opinion, and a very unfortunate change. I've provided statistics in the paper regarding the leverage ratios of banks that either survived or didn't survive the crisis of 2008. Certainly, for example, Citigroup essentially had a leverage ratio of 4% in 2007, and Bank of America just under 5%. Both of those banks received enormous bailouts. And certainly you had your own experiences on your side of the Atlantic with banks that had relatively low leverage ratios because there was no leverage requirement at that point. The other thing that seems likely is that I think there will be proposals to adjust the trading book, risk-based requirements for the trading book. The Basel III Endgame proposal would have put significant new requirements on the trading book. It's possible that those, of course, have been withdrawn. It's possible they would try to liberalize those further. The big banks, I would say, seem most focused on the leverage ratio, and the fact that there's so much focus on leverage ratio and weakening it, making it weaker, strikes me as a fairly good argument for making it stronger. If it is affecting the way they do business and they're really focused on that one, it would seem to me that strengthening the leverage ratios is something worth considering.
Lord Sharkey. Thank you very much for your very comprehensive written report. I'd like to ask you a little about summary paragraph E, which talks about private equity funds facing severe challenges, imposing growing risks on bank lenders and captive life insurances, and so on. Private equity funds and private credit funds are now seeking to sell risky and illiquid investments to retail investors, as well as pension funds and investment funds that serve those investors. Can you say to what extent this presents systemic risk, and how would that manifest itself?
I mean, I think it certainly raises to me some very troubling possibilities. I think the statistics that seem to be widely accepted are that private equity firms are sitting on more than 3,000 portfolio companies with more than $3 trillion of assets that they've not been able to sell. There was an enormous rush of private equity transactions in response to the tremendous pandemic stimulus of 21 and 22, so that you had some $5 trillion of transactions that were accomplished during those 2 years. Of course, then interest rates rose rapidly and have made it very difficult to exit those investments. We've seen significant pushback from institutional investors indicating that they are no longer willing to put more money into private equity, largely speaking. And in fact, some big university endowments are now struggling to sort of get rid of some of their private equity investments, even at a loss. It's not a surprise, therefore, to me that private equity firms are saying, well, let us, sell these investments to retail investors, to retail mutual funds, and to pension funds that serve ordinary people. And I think that should be a concern. Could those investments, crash the economy? I think one thing that concerns me greatly is that economies around the world are so highly leveraged in so many ways that to me there's very little margin for error. Class of investments were to go wrong and there was to be a stampede out of those investments, I think that there would be a contagion effect, a domino effect. And I think you can see these risks not only in what I would call the longer term illiquid private equity space, but if you look at the hedge fund space in sovereign debt markets, the repo market has become enormously large. We don't actually know how large it is, but I think it's well north of 15 trillion, maybe closing on 20. This is all short-term money that can move very rapidly. We've seen a number of disruptions and near crises on our side of the Atlantic in 2019 and 2020, and more recently in April of this year. And of course, you've had your own experiences in 2022 and early this year. So my concern is that I think if you look at any one segment in isolation, one could argue it's not absolutely a systemic risk, although I think the private equity space is now very large with over $10 trillion of assets under management. But if you look at all the sectors together and how leveraged they are, and to me how fragile they are, I think that there has to be a concern that you could see this domino effect. And I think your prior witnesses have pointed to the life insurance industry. I think that we're already seeing very troubling signs of excessive risk-taking being done by captive insurers controlled by private equity firms. So one might imagine how that might spread if you then give private equity firms the ability to sell to retail, what we would call mutual funds, investment funds, or retail-oriented pension funds.
And where in all this are the regulators?
That's a good question. I mean, I think currently, unfortunately, on our side of the Atlantic, the attitude seems to be we need more risk-taking, we need fewer restraints. Certainly, this is shown most dramatically with crypto assets, which are not the focus of your inquiry, but I think they well could become the focus of this inquiry or a separate one, because I think all the problems that I see in what I would call the real economy are now showing up in the crypto economy, which to me to call it an economy is unfair. I think it's an empire of thin air, but it's an empire of thin air that now is drawing a lot of investment, which I think is very unfortunate. So I think that there seems to be a lack of concern among regulators on our side of the Atlantic in terms of the aggregates of risk-taking and leverage that are being taken on. And I know that puts great pressure on your side of the Atlantic, because everyone feels we have to do what the United States is doing. We have to chase the United States. I'm afraid that we often don't serve as very good examples for our elder siblings across the Atlantic. And to me, crypto is one of the most recent of those bad examples. But I think that the amount of debt that we've allowed our economy to take on and our largest institutions to support, I think it is troubling.
Thank you, Professor.
Could you just before I ask Lord Hovick, could you just expand on this issue of the life insurance companies and what you're doing? Can you just explain exactly so I understand?
Yes. So, before they turned to retail investors and retail investment funds and pension funds, private equity first turned to life insurance companies. So most of the largest private equity firms now have acquired captive life insurers. They control about 10% of the life insurance industry, about $1 trillion of assets under management. And this has been an exceptionally favorable and profitable source of patient investment for them, because, of course, if it's a captive life insurer, they're not going to complain about the returns they receive or don't receive. In our country, life insurance is primarily a matter of state regulation. So you have 50 state regulators, and the Federal Insurance Office is really primarily an advisory body. The Financial Stability Oversight Council in the past has designated certain very large insurers as systemically important and therefore subject to federal regulation. But those designations were all removed during the first Trump administration and not reinstated. So essentially, there's no meaningful direct federal regulation of insurance. State regulators have expressed increasing concern about the investment patterns of these captive life insurance companies that are tying their assets up in a lot more of the leveraged loans, junk bonds, private credit obligations that are not traditional, not typical for life insurance companies. But to date, there's only been, I would say, mild pushback. There have been some efforts to tighten asset regulation, but I don't think they've been very successful.
Thank you. Lord Hovick.
Good morning, Professor. You spoke this morning, and in the written evidence that you are going to submit, a high level of concern about the risks that are being taken, and the fact that those risks set also include to the public generally through the process of mutualization, shall we say.
Yes.
And I think you're right to draw attention to this. The private finance market is lightly regulated, and indeed some have argued that provides an arbitrage opportunity, which is being taken grabbed with both hands. So I think it would be interesting to hear from you is how the regulators should set out to look into more closely the interconnectedness of this market, the risks that are being taken by ordinary citizens as opposed to sophisticated, allegedly, financial institutions. How do we shine a bright light on what is going on in a market where information is scarce?
Yes, the Financial Stability Board has issued a new report on leverage in the non-bank financial intermediation sector. One note, when the FSB started monitoring what we now call NBFIs, they actually called them shadow banking, the shadow banking monitoring reports. I thought that was very desirable because these are shadow banks. They operate much like banks. If you look at broker-dealers, for example, money market funds, they're certainly the people who are involved in the repo market and the money market fund market expect their money back tomorrow or the next day if they want it, which to me is a banking deposit. So in the early days after the crisis, there was this focus on shadow banking, which then was changed to a more, I think, a euphemistic term, non-bank financial intermediation. It's interesting because intermediation used to be considered the most classic function of a bank. You take deposits from the public, you provide a safe repository for those deposits, and you make loans to companies that often can't get access to the bond market. So that was the classic bank function, and yet to allow non-banks to undertake it seems to me a very, I think, drastic step, but it has been taken. The FSB's most recent report makes a number, I think, of useful recommendations about ways to try to limit leverage and control it. For example, more disclosure, more reporting, moving systemically important markets such as repos, sovereign debt markets to clearing facilities, which should have their own capital requirements for participating clearers and margin requirements for customers. I mean, and some of those efforts have been made. I mean, the SEC in our country tried to take those steps with regard to private equity firms and hedge funds and put out some disclosure requirements, and they were knocked down by the courts. And so the attempts to implement these proposals have not been very successful, partly because you don't have the statutory basis for imposing them in the same way that you do under the banking system. But I definitely believe that it would be important to move toward more disclosure and then begin to look at aggregate position limits, concentration limits. Certainly, my view is the repo market should be brought entirely into the sunshine, and some kind of clearing should be required for all repos, in my opinion. The fact that we don't know how big the repo market is, I think, is simply unacceptable at this point. So I think disclosure, reporting, clearing, margin requirements, those are all good prophylactics that I think could be useful. But I think fundamentally we should reconsider, is this a type of activity that we want non-banks to be engaged in? What are the risks and costs of doing that? I think we saw that in 2008 and 2020, all of these wholesale non-bank funding markets were bailed out in the same way that deposits were. I think that created a very negative perception, I mean, a very unfortunate perception that these markets were just as protected, but they're certainly they're not regulated in the same way.
Do you think it would be appropriate for regulators and indeed the central banks to warn private investors and small pension funds and the like against investing in these areas because they are rather opaque and that the risks are not fully understood?
Yes, I mean, I think, of course, to me, it's first a question for us, the SEC. I suppose for you, it would be the FCA, perhaps, that, are these suitable investments that should be offered in the first place? if they are to be offered, then I think you're right that there should be abundant cautions, because I think that many institutional investors, for example, I think have been surprised, and not in a good way, by how many of these investments have turned out. And I think it's impossible for the ordinary retail investor to make a well-informed judgment as to how well a private equity fund holding many portfolio companies, all of which are highly leveraged, how well that's likely to work out.
Is it the case, final point, that life insurance funds provide, if owned and controlled by private finance, are effectively a way of smuggling these rather more dangerous and little understood risks into effectively the portfolios of individual people?
I'm sorry, I'm not sure I fully received that last question. Perhaps if you could speak up just a little bit. Sorry.
I'm wondering if the ownership of life insurance companies by private finance allows effectively highly dangerous or risky investments to be smuggled into life funds, which therefore expose the public to those risks unknowingly.
Yes. Thank you. I appreciate that. Yes, absolutely. I think that certainly the average life insurance policyholder who buys a life insurance policy is looking primarily at the premiums and the coverage, and they have very little understanding of what assets are behind that. It's worth noting that during the first leveraged buyout boom in our country in the 1980s and 90s, two very large insurance companies bulked up with a lot of junk bonds and failed in the early 1990s. So we've had experiences before where life insurance companies that were closely connected to the private equity industry and loaded up on their obligations later failed. I mean, this is there are certainly precedents for this. So I agree. I think that allowing life insurance companies to get heavily involved with private equity investments, I think, is a very troubling development.
Totally. Thank you, Chairman. You mentioned that non-bank financial institutions are offering shadow deposits. Could you expand a little more on when a deposit is not a deposit and when a non-deposit is a deposit, and why the law hasn't caught up with us? I thought you had to be registered if you wanted to be a deposit taker in this country anyway, and I assumed it was the same in most Anglo-Saxon countries.
Yes.
If the difference is with things that are sort of a bit like a deposit are not protected, isn't that just a risk people are taking? But perhaps we ought not to allow them to take that risk, I don't know. But I'm just sort of puzzled why someone can get away with taking deposits and not be regulated.
Yes, so I take a very functional approach to the definition of deposit. My view is that a deposit is essentially a financial claim that you issue to me. I give you money, you issue me a financial claim, and that financial claim gives me either the right or essentially the very strong expectation that I can get my money back either on demand or within a short period of time. I have proposed that there ought to be a 90-day cutoff, that 90 days is sort of the conventional understanding of cash equivalent. And I think that if people expect their money back in 90 days or less, that to me looks very deposit-like. In our country, it started with money market mutual funds or money market funds. Now, interestingly, they were structured as equity investments. They aren't formalistically a debt claim. But the understanding has been from the beginning that if you put your money in a money market fund, you can get it back on demand, and that they promise to maintain a $1 net asset value, so you will get your money back. The same thing with a repurchase obligation, that it's a secured loan for a very short period of time, often overnight, perhaps 7 days at the outside. Again, the person who lent the money expects to get that money back with an interest, essentially a de facto interest payment, and has collateral, but if they have to realize in that collateral, there could be problems. The money market mutual fund industry is now over 10 trillion. As I said, repos are probably north of 15, closing on 20 trillion. I think the wholesale markets expect those to be paid. And we saw in 2008 and 2020, the government, the Federal Reserve and the Treasury ensured that they would be paid. Those to me are deposits, but they're not being regulated like deposits. Now, it was obviously very convenient for participants in the financial markets and to some extent ordinary investors to get higher rates of interest, less regulation. There really aren't capital requirements if non-banks are doing this. So, obviously, as often is true, when you do things without guardrails and protections, you can do them more cheaply, and you perhaps can pay higher yields. But there's no margin of safety. And then suddenly, when things go bad and there's a run on money market funds, as there was after Lehman collapsed and defaulted on its commercial paper, or if there's a run on the repo market, as there was when many of the repos turned out to be backed by toxic mortgage-backed securities, then the government either has to say, we'll allow these markets to collapse and pay the consequences, or we'll protect them. I think the government's had no choice but to protect them. But in my view, the government shouldn't have allowed those markets to develop in the first place. There actually is a statute in our country which says that you may not take deposits unless you're a chartered or regulated bank. The term deposits is not carefully defined, but it's reasonably clear. It's much as I have described it. And in 1979, there was an effort to enforce that statute against money market funds, and the federal government refused and said, no, we're not doing that. I think that, to me, opened the floodgates in our country about allowing these non-deposit deposits to develop. Now they're so large, it would take quite a significant policy judgment to move the needle back where it was in 1975. But I think that it's important that policymakers understand the consequences of not enforcing what I would consider to be, strong structural rules about who's entitled to engage in banking and who is not.
And if they were regulated, would the quantity of these pseudo deposits shrink dramatically? In which case, would the lending they're being used to finance shrink dramatically? In which case, would we have to reinvent them?
Yes, I think certainly, of course, the non-banks could no longer offer these, so it would go back to the banks. And I think that because banks, as you point out, have capital requirements, have liquidity requirements, I think one would expect to see at least somewhat less of this happening. Now, of course, some people would say more credit is always better and less credit is always bad. I think one has to look at the current debt aggregates, almost in every country and say, are we on a healthy path toward a sustainable future? I realize that what I'm proposing is, seems like strong medicine, but I think, as I point out in my paper, we've had sort of a series of escalating booms and busts and bailouts. And my question at this point is, who thinks we could finance another bailout like the last two without perhaps crashing the sovereign debt markets? And if we think we cannot, then don't we have to consider taking a different path than the one we've been taking?
Thank you.
And a note.
In your paper, you describe the extensive and hazardous connections between universal banks and non-bank financial institutions. If you look at the stress tests that were recently carried out on the large banks in the US, that actually concluded that they didn't need as much capital as they had. So if did those stress tests, were they not specified in a way that would reveal the hazardous nature or where the risks actually lay within that? Or is there something else structural about the way stress testing is carried out in the US?
I think that there's a widely shared feeling among many that the stress tests have been made significantly easier over the past few years. There's been demand by the industry for more transparency about the factors. And of course, the more that one reveals the factors that are going to be considered, the more that the banks can adjust to those factors and make tweaks in their business models to deal with them. The original stress tests that were done between 2010 and 16 were really quite tough, and there were a number of failures in the sense that the regulators concluded that there weren't sufficient buffers and that certain banks needed to strengthen their buffers. I don't think there's been a failure of any major bank on a stress test, perhaps since 2017. It's been a very long time. And my view is, if no one fails a test, that would indicate either that you have a remarkably smart class of students or that the test isn't functioning as well as it should. I think the 2023 series of bank failures indicated that we didn't have simply a remarkably smart and talented class of students, because three major banks went down and a number of others could have gone down. I mean, I think it's worth remembering that the Federal Reserve stepped in with something called the Bank Term Funding Program, supported by the Treasury, which essentially said that banks could bring their government securities to the Federal Reserve and get loans equal to 100 cents on the dollar on the face value of those securities, even though they had become very depreciated because the interest rates had gone up and the market value of those securities was depreciated. At one point, those government securities portfolios in the U.S. banking system were underwater by some $700 billion. The Fed was essentially guaranteeing that they would effectively close that gap as long as necessary to prevent further bank failures. That would indicate to me that the stress test leading up to 2023 had not been strong enough, and it's very surprising to me that the Federal Reserve allowed large banks to load up with long-dated government securities at a time when interest rates were very low, and it was pretty clear that the only direction interest rates could go was up. So why would you allow banks to go long out on the yield curve with these government securities? So I think my view is stress tests are extremely important, but they have to be made strong enough so that you can be reasonably sure that, as you say, the banks really do have the margins of safety that they claim to have.
And that would include their exposures to the non-bank financial institutions.
Yes. I mean, to the extent that banks are holding large, I think the current statistics indicate that the banks are holding about $2.3 trillion of exposures to non-bank financial intermediaries. I think it's important that we know what are the nature of those exposures, particularly the longer term illiquid ones, and as you say, what are the protections in terms of collateral otherwise.
And just a slightly related point. You talk in your paper, and indeed I think you said today, that the banks have been trying to argue against the leverage ratio and trying to bring that down. Is the leverage ratio the binding constraint in the US, or is it the risk-based capital ratio? Because in the UK, the leverage ratio is rarely described as a binding constraint. So is it a different structure of what's important in capital in the US? Or do they not like any kind of restrictions?
Yes, I think the banks obviously are involved in a lot of off-balance sheet activities with securitizations, with derivatives, and the supplementary leverage ratio really confines those because it takes account of their off-balance sheet exposures. I think the other thing is that banks are very heavily exposed to the treasury market through repos. And again, if sovereign debt is risk weighted at zero, you don't have to hold any capital against those sovereign debt exposures. But again, the supplemental leverage ratio would say no, those exposures have to be taken. Hedge funds reportedly are holding, more than $1 trillion of, basis trade type positions, net short positions in the treasury market, and the feeling is that banks through their broker dealers as prime brokers are funding most of that. Again, one has to say that strikes me as a very, very risky thing to do. I think I mentioned that banks are receiving about $60 billion of investment banking fees every year from private equity funds and hedge funds. That's a very lucrative source of revenue, but 60 billion doesn't seem like a lot of money when you're talking about perhaps 3 trillion or more of exposures. Banks, like all of us, tend to be short-term oriented. This year's results, this quarter's results. Banks generally don't tend to pay as much attention to longer-term risks unless someone requires them to do so. And so I think that the off-balance sheet nature of many of the largest banks' operations and their very heavy exposure to the treasury market, I think explain why the supplementary leverage ratio has been so bothersome to them. At least that's my opinion.
Thank you.
Lord Hill.
Thank you. Can I just go back on some of the things we've already touched on? To what extent do you believe that the regulation of banks post-2008 has contributed to the rise of private credit that we've been discussing?
Yes, I think that the decision made in 2008 was, in my opinion, not to change the basic business models that had brought us the financial crisis, which were universal banking and shadow banking and their interactions, but to try to make both of them safer through stronger capital requirements, liquidity requirements, stress tests. But of course, those were only applied to banks. Now there was, to be fair to the drafters of Dodd-Frank, they assumed that the Financial Stability Oversight Council would designate systemically important non-bank financial institutions, and those would be essentially subjected to the same kind of capital and liquidity requirements that big banks were subjected to. And in fact, FSOC designated at least four. GE Capital was one, and the other three were major life insurance companies, not surprisingly, including AIG to begin with. I think Prudential and MetLife were the others. So that would have created at least somewhat of a more level playing field if that had continued. Of course, it did not. Under the first Trump administration, all four were declassified, and no others have been classified since that time. So then you had a completely unlevel playing field where large banks, did have these higher requirements and resented them, and large non-banks essentially didn't have them. So as you say, it's not surprising that you would see more of a migration to the private capital side. As I suggested in my paper, if you look at today's private equity firms, they very much resemble the big five securities firms that existed before the crisis, the Goldman Sachs, the Morgan Stanley, the Lehman Brothers, Bear Stearns, Merrill Lynch. They do much of the same thing. They all have large broker-dealers. Now they all have captive life insurers. So we have recreated the business model of the big five. Of course, we should remember that one of them failed, which was cataclysmic, and the other four either emerged into bigger bank holding companies or became bank holding companies themselves. So it seems to me that's a disturbing set of precedents that we ought to pay attention to.
In the political world we now inhabit, particularly on your side of the Atlantic, but that's reflected in many ways in other jurisdictions, the likelihood of there being the kind of regulation that you would have wanted 15 years ago seems quite slight. So in those circumstances, which is the lesser of two evils? I mean, is it to carry on with the current imbalance between banking regulation and shadow banking regulation, or is it, in your view, would it be even worse to think about how you try to reduce some of the regulatory burden on banking?
Yes, I think, to me, taking the existing regulations off large banks is a recipe for sure disaster. I mean, I think that they with all their complaints about non-banks, the biggest banks still hold the whip hand, in my opinion. They are still the ultimate source of liquidity for the markets. They still have the strongest connection to the federal government and the federal safety net. They won't be allowed to fail. So, I mean, so I think that to weaken them would be really catastrophic. I think that, as I indicated, I think the Financial Stability Board's recent report on reducing leverage on the non-bank side has a number of useful recommendations. And I think, moving more of these fragile markets into a clearinghouse type of facility, requiring substantial capital for the clearing, those who clear the obligations, and substantial margins for customers. We have seen some positive developments in the Treasury market and to a limited degree in the repo market. So I think that those would be positive steps. And I think that the best that we can try to do in this current environment is to persuade people that governments simply don't have the capacity, and societies don't have the capacity, to do another set of bailouts like the last two. And if that is true, then the only answer is to have stronger prudential requirements for financial institutions on both sides of the line.
And sorry, we touched on it right at the beginning. The decline in small and community banking in the States, and we have similar challenges here. I mean, the challenger banks never got going after the financial crash. What are your thoughts as to what we could do to try to help that part of the banking sector?
I do think that giving more focus to the formation of new banks is essential. I mean, one thing that's happened in our country is that it's virtually impossible to launch a new bank in any community of any size without $20 million of equity capital. That's essentially sort of the price of admission. And for many smaller communities, I mean, $20 million is just out of reach. And so, again, I don't favor forming banks that are doomed to fail, that don't have a reasonable chance of succeeding. But it seems to me that there must be ways of solving the capital puzzle, whether it is by stretching out capital contributions over a period of years. I think whether it could be that there ought to be some government programs to help with initial capital, then require it to be paid back. simply to say, well, if you don't have $20 million, you can't open a bank, I think dooms a lot of smaller communities and rural areas to having no banks at all. And I think that I know in my country, and I'm sure in yours, you can see what happens when a community does not have a bank, what happens to its economic development and to its civic life. So I think that formation of new banks should be a top priority. I think then simplifying the regulatory requirements for those banks, I think should be a priority too, but not making them weak. I mean, it seems to me that if you have a leverage common equity ratio of more than 9%, that's a pretty strong bank if it is well managed and has a good business model. So I don't think that kind of bank needs the full panoply of Basel III requirements. Again, if it's providing a classic traditional banking service.
Thank you.
Alice?
Thank you. I've got a little rag bag of questions now. Maybe if we take them individually, because they're not necessarily related. I think following on from the discussion with Lord Hill, I mean, I think that what we're saying is that what's in the shadows doesn't stay in the shadows. So it can either go into banks where then you've got levels of regulation or supervision. If it's not in the banks, then one can have clearing obligations as a way to get a handle on it. So does this mean that we should have more mandatory clearing obligations introduced to perhaps address things like the repo market and so on?
Yes, I think it certainly is essential, I think, for sovereign debt markets that there should be central clearing. It's just too important, I think, that we've seen repeated disruptions, and as sovereign debt markets keep getting larger, the need, I think, for transparency and for the kind of liquidity that central clearing gives you are essential. Now, of course, some people will say, and it's true, well, then the central clearing facilities can be themselves a source of systemic risk. And I agree with that. But the way to respond to that, I think, is to have robust capital for the clearing facility and robust margin requirements. Again, those aren't foolproof, but they serve the same kind of function that capital and liquidity requirements serve in banks. If they're strong enough, they should certainly help a great deal. The repo market, I continue to say, this is a market that cries out for much more transparency. And I think at this point, full clearing, and unless I'm missing something, I think that when a market becomes north of 15 trillion and maybe 20, I pointed out in my paper to a recent Federal Reserve study that said that the repo market in the U.S. was 12 trillion. About more than a third of it was sitting in the shadows in these bilateral repo transactions that are not transparent. I mean, that was quite a surprise. I don't think many people, perhaps other than those who really know, I don't think many people like myself on the outside thought that the repo market in the United States was 12 trillion. What they did was simply to take reports from broker-dealers, which are available from the SEC, some of them, of course, independent, most of them bank-owned, and extrapolate. And the extrapolation seemed reasonable. But a market that large, I think, cannot sit in the shadows. I think you put it very well that what's in the shadows doesn't stay in the shadows when trouble comes. Warren Buffett used to put it in a more blunt way by saying that, when the tide goes out, you find out who was swimming without trunks, which is sort of a good metaphor for financial crisis. I think the same way with the repo market. It won't sit in the shadows during a crisis as we saw in 2008 and 2020. So I think, yes, central clearing with good capital, good margin, that's an important first step. I think that doesn't address the longer term illiquid asset exposures of the private equity industry and now an increasing amount of a part of the life insurance industry. But again, one could talk about disclosures, concentration limits, diversification requirements. Again, if these are now, a professor named Andrew Tuck, Tuch, wrote a very good article called The New Wall Street several years ago, where he pointed out that these private equity firms had essentially replaced the old big five, Wall Street securities firms. If these firms are as important as they are, and I believe they are, then they should be subject to these kinds of prudential requirements. The old securities firms, the requirements perhaps weren't sufficient, but they did have capital requirements, and they were monitored to some degree for these kinds of asset concentration problems. Certainly, I think the big private equity firms should be similarly subject, and I think that we obviously need to pay more attention to the life insurance industry now. I think not having a significant federal presence, regulatory presence in our country has been a continuing problem that needs to be addressed.
I would like to move over into the issues of insurance and captives. I think for purposes of this, I better declare an interest as a director of a captive insurer and also of its parent company. I'm not sure it's terribly relevant, but I think for form I have to do it. You indicated your concern over what captive insurers were holding in their portfolios, and I think that this was largely to do with the life insurance, so it's the captives of an insurance company rather than the captives of manufacturing industry, or do the problems extend into those kinds of captives? So that's the first question on that. And the second is, well, we're about to possibly launch into having captives allowed in the UK. I mean, it's been announced, and the Bank of England, PRA, have been reluctant on captives for a long time. So what should we be looking out for here? Are we opening ourselves up to just a repository for deadbeat private assets?
Yeah, so I think I agree with you that captive life insurers probably have more immediate concern than perhaps the typical captive portfolio company, although we could discuss those as well. But the captive life insurers, I think, have particular concerns because, as I mentioned before, the typical life insurance policyholder really has very little idea of what assets the insurance company is holding. The policyholder assumes that regulators are watching that company to make sure that it's safe, and that if it carries some kind of AM Best good rating, that the ratings agencies have paid attention as well. I think, as you say, what we're seeing among the captive life insurers is that they are loading up with the leverage loans, the junk bonds, the private credit obligations that obviously serve the interests of their masters and may not serve the interests, and perhaps probably don't serve the interests of their policyholders. That is a concern. I mean, I think that if a life insurance company is not being managed in the long-term interests of its policyholders, that is to my mind, a serious problem that needs to be addressed. Of course, the same issues have been raised with portfolio companies in terms of, loading them up with debt and removing safety parameters and things like that on manufacturing companies, healthcare companies. I mean, that raises a whole series of similar issues, but not in the financial sector so much as the broader societal sector. But I think that that holding companies are always worth watching, because the question becomes, is the subsidiary being run in its own interests, in the interests of those who've invested in the subsidiary, in the case of bank depositors or life insurance policyholders, or is it simply being used as a vehicle for wealth extraction by the parent? And holding company regulation, I think, has tried to address those problems. But as I indicated, we don't have a strong federal holding company regulator in the insurance industry in the United States, and I think that has been problematic. I'm less familiar with the UK's approach to insurance regulation, so I can't make the same comment there.
Right, that's perfect. Well, it gives me some things to dig around in as we move forward in the UK. My final question is actually about how we get or don't get to having the sort of community-type banks in the UK. I mean, there are lots of issues around trying to do that, but what we do have is ring-fenced banks. And I'm just wondering what you think about the ring fence and whether we've got it in the right place, because we have, well, they're not really challenger banks, but the more modest-sized banks that are ring-fenced, and they complain that they end up with higher capital requirements and they can't do the sorts of lending that they want. That's probably largely due to a lack of an internal model. But I noticed you did say that that's the situation that pertains in the US as well, in that you've got the community banks in general holding 10%, versus 7% for the big multinational G-SIBs. I mean, is that therefore an inevitability? Are we trying to, when we want to bring down the capital requirements on these sort of smaller banks, are we actually fighting the inevitable?
Yes, so I'll take that in two parts. I paid a lot of attention to the Vickers Commission report when it came out, and I've called that approach, the ring fencing approach, what we might call internal Glass-Steagall, which was to separate the deposit-taking aspects of a universal bank from its capital markets activities, and to prevent the deposit-taking side from subsidizing the capital market side. And I actually think that's a very prudent and sensible approach for large universal banks with large amounts of capital market activities. I think one of the most problematic aspects of universal banks is that they use their deposit-taking function, for which they pay almost nothing, to support these very speculative activities in the capital markets. And I understood ring fencing to be a way of trying to stop that. So for a large bank, let's say similar to HSBC or Barclays, that makes a great deal of sense to me. And of course, the other advantage is that it makes the bank somewhat easier to resolve if you have to, although it'd be very difficult to resolve a bank of that size, but it makes it easier to resolve if you can more easily separate the deposit taking from the capital market side. So I support what I understand to be the ring fencing approach for the large, what I would call capital markets banks. Now, I gather that the cutoff has been more based on asset size than on activity. And so I think 25 billion, I believe, has been your cutoff, although maybe that has been raised more recently. I would say that there ought to be a combination of asset size and activity. In other words, if you had a bank that was $50 billion, but had no real capital markets activities, it wasn't engaged in underwriting or dealing in securities or derivatives, I could see why the concerns about ring fencing that bank would be less, because it's not engaged in speculative activities in the capital markets. Now, if the bank got to be 100 billion, maybe at some point the size could be more important. But from my perspective, I was always more focused on separating activities than simply applying an asset size cap. So if you had a challenger bank, again, that was at $50 billion, but was doing a traditional deposit-taking, traditional lending business, serving SMEs, I could see why it would make sense, not to require ring fencing for that kind of traditional bank. Whereas a bank that was $20 billion, but had most of its operations in the capital markets, I would be more concerned about ring fencing. So I would say I would focus more on the activity separation than simply the asset size. Is that helpful in response to your question?
I think so, but there's also the rider. If we're looking at the banks that don't do any capital markets activity, why is it that they end up having to hold more capital than those that are doing things that we perceive as more dangerous?
Yes. I think that I don't see the need for what I would call exemplary or exceptional capital charges for a traditional bank, unless perhaps it reaches a size where you consider it to be systemically important. And I wouldn't think that was 50 billion pounds. Would it be 100 billion pounds perhaps? But I think that, in my opinion, systemic importance depends quite a bit on size, but I think it also depends quite a bit on activity and how speculative and how risky those activities are.
Thank you.
My question is going to be about what are the chances of better international cooperation between the various supervisory systems. But before I ask that, are you able to say what, in your view, is the top priority to make the United States financial systems and institutions safer? What would your top of the list be?
My top priority would be exactly the opposite of what they're doing, which is stronger leverage capital requirements. I would want to increase the enhanced supplementary leverage ratio. I would prefer it to be 10%, but I would, certainly toward 10%, because I think that is the strongest restraint that we have under current law. My second priority would be to try to see if we couldn't do something about at least getting all of these shadow deposits into central clearing arrangements with more capital, more margin, more transparency, so that at least we knew what we were dealing with, and there would be some buffers of safety before a crisis comes.
Thank you. Well, that brings me on then, because the supervisory systems internationally seem to be so different that one wonders how you could get some international cooperation, for instance, with the visibility of where this money is all flowing to and from, the valuation of it, the accountability, and of course the political priorities, which we don't have that much control over. What would you think? What is the state of play, would you think, on international cooperation on these systems?
I think central banks would be the understandable forum to start with. So I think that the Bank for International Settlements, which is sort of in some ways the central bank of central banks, and the Financial Stability Board, which I think has generally played a positive role, although it has had its moments of being stronger and weaker. Obviously, Basel sits within the BIS. I mean, the Basel Capital Accords certainly are far from perfect, but I think they were a significant step forward. I think that possibly with the FSB saying that they really are concerned about non-bank leverage, there might be some opportunities to move toward more central clearing, stronger disclosure, stronger position limits. I agree with you. It will not be easy. I do tend to think that if the US, the UK, and the EU could agree on a common approach, and that's certainly easier said than done. But if those three could agree, they would inevitably, I think, carry most of the rest of the developed financial world with them, because clearly most of the major financial centers, particularly for private enterprise, are in those three jurisdictions. I mean that I sometimes get discouraged when people say, well, it's always a race to the bottom. And that's certainly a temptation, but I think having the reputation of having the strongest banking system, the strongest financial capital markets has to count for something. I mean, with all our faults, there's a reason why the U.S. continues to be a magnet for investment, and I think it's because we have had, on the whole, strong banking and capital market regulation. Certainly has fallen short in many ways, but I mean, comparatively, we've done reasonably well. I think the UK falls in the same category. I think the EU wants to fall in the same category. So I think I would encourage the US and EU and UK to lead a race to the top instead of a race to the bottom. And I think thoughtful policymakers like yourselves, through your deliberations and reports, I mean, you can support what I think the BIS and the FSB are trying to do. I mean, they desperately need support because they're constantly being hammered by the financial industry for being, the usual word is you're being a Luddite, right? Or you're frozen in the past. And my own view is that the past tells us some very important lessons about what's likely to happen in the future. We've seen these patterns of boom, bust, and bailout recur repeatedly, and we ought to learn from them and not be afraid to look back at them.
Thank you very much.
Professor Wilmarth, I think we should allow you to go and get some breakfast. Can I just say, throughout this session, I was reminded of our late Queen Elizabeth's remarks after the financial crisis, when she said, "Why did no one see this coming?" And listening to your evidence, I think you've given us a lot of food for thought, which is very much appreciated. And if I could just say, on a personal note, I particularly enjoyed paragraph 54 of your paper, which complimented the House of Lords Economic Affairs Committee on their report on quantitative easing, which you said showed great insight, and where you said that we answered two of the questions. There's not time to go into the third question, which you highlight. But if you felt able to answer that third question, or at least give us your thoughts in further written evidence, it would be appreciated. I've really enjoyed listening to you and the way in which you have shown such frank and careful analysis of some of the issues that are involved. And so on behalf of the committee, can I thank you, and any further information or evidence you want to give us would be very much appreciated. And that concludes the session, so thank you very much.
Thank you very much. Appreciate it.
Thank you.